Who killed gold, and is this the beginning of a bigger sell-off or the dip to buy? All this next. Just when we thought things were getting boring in the gold market, it dipped below the $1,500 mark today briefly, rebounding back afterwards. Joining me today to help make sense of what happened today, Vince Lanci joins me.
Thanks for having me.
Who's the culprit behind today's drop, Vince?
Draghi did it.
In our year-end special, Vince, you called it saying Draghi would be one of the most influential people. And in last week's episode, you also were telling me that you were looking at a $1,400, $2,500 model for gold. $1,400 not seeming improbable right now.
I'm sure there'll be different stories and information is going to be coming out, but about why we sold off, 4 million ounces were sold on the open, as you pointed out to me. But the catalyst for today's movement was absolutely, if you look at the other markets have not reacted the way gold has, was Mario Draghi saying that Cyprus, while we're not telling them they have to sell their gold, if they do sell their gold, they have to use it to pay down their debt and to help secure the loans that we're giving them. So that was basically him telling them, sell your gold or you're not going to get the money in one way or another. And that spurred a very disorderly sell-off in the market. And I think the market is going to be suffering for a while on that. What this really was, if you want to look at it as a war, this is a triumph. This is a big win for Keynesianism over the Austrian school of economics.
Vince, what do you mean by that?
The ECB, the US, every central bank that has so much of its wealth in fiat currency has a vested interest. So when a bank is buying CCC bonds on a country that could default, and the ECB is saying, we promise you, we'll make it good, just sell your gold, they're making it happen. The cliche that markets can be can be irrational longer than you can be solvent or liquid. Well, substitute the word markets for governments, because governments are the market now. Governments can remain irrational in their economic policies longer than you can remain solvent. So this is a triumph of Keynesianism, temporary or not, over the Austrian school of economics.
But Vince, knowing Mario Draghi's track record, does this statement not surprise you? Why make it now, knowing the impact it would have?
Right, he's not a fool. He doesn't have a reputation as a loose cannon. You put him on par with a Bernanke or a Greenspan, and I'm very shocked and disappointed that he would do that. Simply as a trader, he undermined Cyprus's ability to sell gold at a higher level. He should have made that statement after Cyprus had sold its gold. I don't think he served the country very well.
And Vince, I don't like giving my opinion, but having followed Draghi's political and public life for quite some time, I have to say that this statement shocked me, seemed out of the ordinary, and I'm shocked by it, Vince. If
you're looking to me to add something to that, I really can't. I agree with you. And frankly, you're the European expat, and you actually worked in Italian politics at one time. So I'm listening to you talk right now. It's not the other way around. The bigger issue at play then, Vince, is will this cause a domino effect? Do you think we'll see other European nations follow in Cyprus's footsteps? And is this perhaps the reason we saw this strong sell-off, is that there's that perception or anticipation that this domino effect will happen? The sell-off was strong. Well, if the sell-off continues, it is because of the perception of a potential domino effect. Absolutely. Peripheral or southern countries, if you want to look at it geographically, southern are weaker than northern in terms of economics. If I'm Italy and I know that I'm going to get a margin call on my debt or whatever you want to call it, maybe I'm going to sell my gold now too, because it's going to happen. Even if they don't sell their gold, the perception that it could happen is enough to drive longs out of the market. And that will exacerbate the move and continue the move. I think today's move was down hard and down fast, not because of manipulation, but because of the butchering, in my opinion, of Draghi coming out and making that statement. And then everyone just plowing into the market at the same time to either get out or get short. So to answer your question in a sentence, there's a very real danger of a domino effect. Even if the domino effect does not happen, people will be much less likely to buy gold knowing that that could happen. It's a problem.
Okay, Vince, now the question we all want answered. We're near the $1,500 mark. What do we do? Is this the beginning of a bigger sell-off, or is this the dip to buy?
Let's look at it from two perspectives. The first perspective is I don't know if the bull market is over in gold, but our model says 1,400, 2,500. So we're buyers of gold, but we have to be careful at what prices we're willing to buy at. But from a more practical answer to you, still not knowing if the bull market is over, right now you should say to yourself, if you want to buy gold. In your mind, buy gold. Now ask yourself, and put a number on it and write it down on paper. And then ask yourself, if the market drops $50, will you buy more? And if the answer is no, then do not buy gold now. Because if you buy gold now and it drops $50 and you're not willing to buy more, you will be selling it because of some other event. Tuition goes up, some other reason. But if right now, Daniela, you say, I'm willing to buy more gold $50 lower, then buy it now. So what I'm really backing into is dollar cost averaging. Don't use leverage. Don't use debt. Don't spend what you can't afford. And the answer is I'm buying now, and I'm buying $75 lower. But I'm not buying a lot.
So Vince, does this spell the end of gold's bull run?
There are actual technical analysis rules for what makes a bull market over. Like, for example, when there's a recession, 2 quarters of negative GDP growth. Bull market could be over depending on when you draw the trend line. Some people would say it wouldn't, but I'd say by most measures in technical analysis, if the market stays down here for any length of time, say a week, say 2 weeks, I think on paper, and I ignore paper, but you have to look at it, even if you do ignore it after you look at it. On paper, this says end of a bull market. To me, it says weak hands to really strong hands, and I'm going to continue buying. But I'm not going to have more than 10% of my net worth in it, so I can sleep at night. So
you know what I think, Vince? Things just got exciting again.
Yeah, that's a good way to look. That's a good way to look at it.
Vince, finally, I know you touched on it before. Gold down over 4%. Any thoughts on that?
There is a well-known unwritten rule that the paranoid bulls use to protect themselves from being too bullish. Gold's not allowed to go up 2%, more than 2%. But it sure as hell is permitted to go down 4%. And take that for what it's worth. That's how the market operates.
We'll let the folks out there draw their own conclusions. Vince, thanks so much for taking part in this special video edition.
I appreciate it. I'm happy to be alive after a $50 drop in gold.
Absolutely, and we'll see you next week. And thank you for watching this special edition of Kitco News. I hope it was an exciting Friday for you. You can email me any comments or questions at newsfeedback@kitco.com or follow this conversation at Daniela Camboni. Thanks for watching.